Given the amount of attention that has been paid to Brent prices over the last year, since they began their slippery slide in mid-2014, it comes as no surprise that oil and gas companies have been subject to a rocky road of late, as demonstrated in Xerfi Global's recent report on oil and gas companies. Their business environment has indeed been shaken up by the shale gas revolution, the challenge position of the OPEC, increasing supply and sluggish demand, more viable forms of alternative energy, and now slowing emerging markets where energy requirements have been expanding the strongest. Indeed, their recent profit margins show the fallout of such an environment. The aggregate operating margin of the companies analysed in the report fell to their lowest point in the last 7 years in 2014, 9.2%. This puts them below levels seen in the aftermath to the global financial crisis, when operating margins fell to a low point of 11.5% in 2010, before rebounding to 14.3% in 2011. Lower selling prices are not, of course, the only element to blame for the slipping margins since 2011. Even before oil prices began to tumble, profit had already started feeling the squeeze of slowing sales combined with increasing capital expenditure, often for complex, non-conventional projects. Indeed, aggregate capital spending among the basket of players increased sharply from 2011 to 2013, with companies enthusiastically investing in exploration and expansion, particularly in non-conventional projects, spurred on by high sales prices. However, spending cooled in 2014 when oil prices began to take a tumble and groups scrambled to rationalise investment and costs, putting on hold or postponing the development of costlier resources such as oil sands. Nevertheless, such aggregate figures hide the fact that oil and gas has become a two-speed market. When analysing growth in sales, two groups of players clearly form. On the one hand, there is a group whose sales have seen little overall growth since 2008. Here we find the big Western players such as ConocoPhillips, ExxonMobil, Total, but also Chevron, BP or Eni have followed the same trend. On the other hand, another group of players has seen much healthier results. These players are state-backed companies or pure NOCs, such as Petronas, Gazprom or PetroChina, who takes the cake in terms of growth, with sales more than doubling between 2008 and 2014. One of the reasons for PetroChina's success is that it finds itself in the heart of demand for petrol. Asia-Pacific now accounts for over 1/3 of global oil demand, followed by North America at 24.5% and Europe at 21%. However, it is true that China is coming out of a phase of very high energy growth, which is slowing as its rapid industrialization comes to an end. In this changing and uncertain environment, particularly independent but also state oil companies need to stay agile and adaptable so as to ensure that they can continue to develop resources while avoiding risky projects. They are making moves both upstream and downstream to achieve this. Upstream, reserve management is cautious and many companies are fine-tuning their portfolios with possible divesting. CapEx is subject to a high level of discipline and riskier, lower-earning projects are being suspended or cancelled. Companies are also aiming to gain an efficiency in oil and gas recovery through innovation and are also moving towards gas, which should see stronger demand growth than oil in the mid-term. Downstream, they are also looking to diversify their earnings by tapping into petrochemical demand and maximising refinery operational efficiency. Indeed, it seems a nimble dance between growth and discipline will be what allows oil and gas companies to forge a pathway through volatile times.